All right. Hi, everyone. Welcome to day one of Synergy Traders number 52. This is titled 30 Experts' Favorite Indicators. So for 3 days, today, tomorrow, and Thursday, we are going to be live with 10 presentations each day with top trading educators sharing their favorite indicators. So this event is brought to you by TradeOutLoud and Timing Research, along with our co-sponsors, MadHedgeFundTrader.com, MPTrader.com, ElliottWaveTrader.net, and LogicalSignals.com. And today, to open the event, we have Adrian Manz of TraderInsight.com. So I'm going to go ahead and turn it over to Adrian.
Cool. All righty. I am happy as always to be here. I love doing these things with David. I think they're really high quality events and get some good folks on here. So I was unoriginal enough to call my presentation my favorite indicator. So I'm going to show you a couple of things that we use. We trade full time. As a matter of fact, we're on the road right now. Some of you guys know that I do a lot of live presentations. I do a lot of live groups, and we've got a bunch of traders all over the United States. So we're from Malibu, California, but right now we are in Cleveland, Ohio. We're just outside of Cleveland, Ohio. We've got some traders who joined us, and we're working with these things, and they are working with some of these right now. We just had one of these trades. I'm going to show you go off, but I've got a little presentation for you here just to show you what it is that we do. So Julie and I, that's my wife, Julie, and me, we look more or less the same. This is a while ago, but we started trading together in graduate school. So everything that we do is based on a bunch of stuff that we did when we were grad students in the 1990s. And, we developed this pretty extensive trading idea, this trading system, which is based on inferential statistics. And we went through, and things had a lot of, pretty heavy statistical backbone to them because we did a lot of stuff with the New York Stock Exchange. So when I was getting my PhD, when I was getting my MBA, my PhD, and Julie, same thing, right? We were in the same class. You needed data. And we were fascinated with behavioral finance. So we're both psychologists. We both have PhDs in psychology. The specific area that we focused on was behavioral finance. And behavioral finance, in our case, focused on what goes on when human beings interact with the market, what goes on in the markets themselves when different forces are pushing and pulling and making things happen. So by the time we got done with grad school, we decided we were it's a long story, but this guy, Peter Drucker, was on my dissertation committee. He's a really famous business guru from back in the 60s, 70s, 80s, I guess. By the 90s, he was already a pretty old guy. And he says, if you've got a profitable business, you'd be crazy to go work for McKinsey and Company. So I passed on a job offer, and we have been doing this ever since. And the way that we figured out to make trading jive with the other stuff that we thought we were going to do in life is we publish a lot, we speak a lot, we do a lot of education stuff. The things that we thought we were going to do in the world of higher education, we were able to do in the world of trading. It's been super rewarding. You guys probably know we do boot camps. We speak as often as we can at the live trading events. We're usually a featured speaker at the traders expos and the money shows and stuff. We don't pay to be there. They have us come and talk. And I wrote a lot of books on trading. And the one on the top left corner, it's out of print right now. It'll be back in print as soon as I live up to my obligation to my publisher. I'm about 8 months behind on it. It's supposed to have a giant rewrite and a big section on psychology. Around the Horn, a trader's guide to consistently scoring in the markets. That is still the backbone of everything that we do. All the other books were just derivatives of that. And it was originally called a multivariate analysis of covariance in the United States equities markets, right? When it was an academic paper. But for what we're doing, and for the people we were presenting the book, we decided to redo it around a baseball metaphor. So a lot of the things that you always hear me talk about, fastball, that's an expansion of range and volume, infield fly, that's an exhaustion reversal on a big move, line drive, that's sort of a gap and go, Baltimore chop, which I'm going to talk about today. That is a statistical market reversal, has a 95% confidence interval of the mean, and gets you to a profit more often than it gets you to a loss. So today's symbols for those, if you want to just pull up IRDM and PII, those were the two that we had today. You can look at them in real time when I'm talking about that pattern. We also do, like I said, we do these boot camps, and the importance of the boot camp really is to look around that table and understand every one of those people has a unique psychology. And when you're trying to trade, like the folks I have here this morning who have been trading with us, what we're working on mostly is not technique, not style, but psychology, because psychology is really, really difficult to get by. You think you have a grip on it, you think you have a good understanding of yourself, but you go around that table. I see there's a cop, there's an entrepreneur from Toronto, there's a guy who's a medical engineer, there's another guy who's a owner of real estate. He owns a bunch of apartment buildings, another engineer on the side, an attorney. They all come to this from a bunch of different backgrounds, and they all come to it with their own baggage. So whatever you're doing when you're trading, you've got something that you've done in the past that you think is going to contribute to your success, but may or may not make it difficult for you to trade. There's definitely no guarantee that you're going to be successful as a trader just because you were successful as an engineer, just because you were successful as an architect, as an attorney, right? Whatever it is, a pilot there. I'm just looking at these pictures. It's hard. And it's very hard for people to wrap their head around that this is a very structured kind of a business, because it feels like there is no structure. So the fella is here this morning, right? We have an Apple trade that we do every day. I'll show you that in a minute. And, he'll form a judgment about what Apple's doing based on where he thinks the market's going in the morning. This is the thing that's hard for you to overcome, right, John? And the reason it's hard for him to overcome is because he's got sort of a gambler's mentality. And that's one of the things that he does. He was a professional gambler. And if you're bringing that to your trading business, then you need to understand the impact of it, because that Apple trade is a long only trade. And as soon as he sees it going in the other direction, he feels like he should jump on the short side. And then he winds up on the wrong side of the trade when it does exactly what we know it's going to do. It's the frustration. And the easiest way that I have come around to with trading, if you want to maximize your results, you have to know what you're going to do before you're going to do it. So we focus on the workflow. So today I'm going to show you a few of the setups and a few of the indicators that I use based on the first three sections of this timeline here. So in the pre-market, we set up our Apple opening trade. The Apple opening trade, I'm going to show you in a second, that's based on some market maker arbitrage and the reaction that we think the market's going to have on the opening bell. Once we're in the open, that Apple trade is going to take care of itself. It just goes and it says, all right, market's open. Here's the program. I'm going to run it. We also have these other trades, the around the horn trades. That's a trading plan that I put out every night. I've put that out for 27 years. 27 years, it's never had a losing year. We know how it performs month over month. It does great, right? It's got, up months. It's had some down months, not big down months. It had some flat months. Overall, we know how that thing does, and it's NYSE. So there's very little volatility on those trades. We know we can pre-program those. There's no reason for Julie and me to be involved. The only thing that, it's like our son Connor is 16 years old and, out on his first date. And I was like, he says, well, are you guys going to show up? And I was like, the only thing that the Manzes can do if they put their fingers into this pie is mess up your evening, right? Mess up the dance. That's the same thing with those program trades. There's no reason, if we know the entry, the stop, the target, and the money management rules along the way, there is no reason for us to intervene. So we set those trades up and we forget them. We let them run and they just take care of themselves. Once the bell has rung, at the 5 minute mark, we start working on the Baltimore chops. And the Baltimore chops that's the opening gap trade, and I'll talk about that in a few minutes. But let me just show you one of the indicators that I use. This is a very, very simple indicator. It's included in every piece of software out there. You are not looking at all for a reinvention of anything. It's not proprietary, just floor trader pivots. So this goes back to, if you can believe it, when Julie and I started in the 90s, when we started trading originally, not when we were sort of professional traders, but when we originally started, this was it. There was no live online charting because you were using dial-up modems and 56K and all this junk. And even floor traders were not looking at live charts. What they were looking at was, where is today's fulcrum? Where's the value line? And the value line is called the pivot. So that's P up there. It's the red line on my charts when you see them in a second here. And that is yesterday's high plus low plus close divided by 3. And it sounds completely arbitrary. And it really is sort of the gravity point, the main gravity point for the market for the current session, if the current session opens in line. So if stocks open in line with yesterday's close, you're going to expect price to oscillate somewhere in the vicinity of that red line, of the pivot line. If it comes down from above and touches the pivot, what you would expect is that it's going to move higher. And when it moves higher, you're expecting that it's going to move into first resistance. The first resistance line, which on my charts comes the blue line, is just 2 times the pivot minus yesterday's low. The first support, which is below the red line, is going to be 2 times the pivot minus yesterday's high. And then a second resistance, a second support, right, on those days where the market gaps. So let's say the market gaps up. The blue line, which is going to be R1, is going to become the fulcrum. We're going to expect that to be the fulcrum if the market gaps up into that range. So that becomes sort of the pivot then. And then R2, second resistance, is where we expect the price would go to and then probably track back down into R1. That's P, the pivot, plus the quantity R1 minus S1. So first resistance minus first support. And then the second support is going to be the pivot minus the first resistance minus the second, pivot minus the quantity R1 minus S1. So these things, they sound a little bit arbitrary, and really the calculations aren't important. I think it's just important that you understand where they came from and that they're there, right? There's a reason for where your charting software is putting those pivots. The next thing that Julie and I look at quite a bit is we use a piece of software called RealTick. That is our primary trading vehicle. It's not cheap, so it's an institutional piece of software. It's not expensive. I don't think it's about $350 a month, I think. We pay it. We don't have endorsements with them. We used to a long time ago, but they've been bought out so many times now. They're owned by SC&C. Totally different ballgame. It's institutional software. It has something called volume by price, and then it has volume by price. It's a cluster analysis. So I worked on this with them years ago. And what the cluster analysis does is it goes through and it says, for any given price level, what is happening in terms of volume right now, and how important is that volume given to where price has been. So cluster analysis it's a statistical technique. This is proprietary to RealTick. It's nothing you can't sort of extrapolate if you just use your volume profile or your traditional volume by price. If you guys are on TD or you're on TradeStation or something, and you're just using a regular volume by price indicator, you can get the benefit of the data. You're just not going to get the clusters that do the interpretation for you. You have to do the interpretation yourself. We also use an anchored VWAP. So anchored VWAP we use quite a bit. I'm not really going to talk about this one today, but understand what a VWAP is, right? The VWAP is the volume weighted average price, and usually it's for the trading session. So the trading session volume weighted average price would be from the open to right now. Where is the average price by how many shares went off? So it gives you a a gravity point for the market. It tells you, man, this is where the market's likely to go because this is where most of what's happened today, has gone off. The anchored VWAP lets you go through, and what I do is I'll take trend points in the market. I'll take a big swing move, and I'll just say, okay, from the peak to the trough, just the same way you would do a fib expansion or something. Draw the volume weighted average price, and then Realtic will go in and just plot it right there and tell me, for the big move lower, for the big move higher, here's where the volume weighted average price was, and it's not for the entire session. So it makes for a nice way to go in and say, where might there be additional support and resistance if we see it. So think back to that timeline that I showed you. If you're looking at that Apple trade, right, which was our first trade of the day, this is where we're focusing our attention. So this chart, this is from, it's probably yesterday or a couple days ago. And you can see the pre-market is over here. So let's get a line on the chart first off. So here, the first thing that you see is, well, here's a support and resistance line that we would draw. And that support and resistance line is based initially not on that ladder data, but it's based on what goes on in this box. So the box is the pre-market. And to understand the way that we're using this particular trading day, this particular trading indicator, is market makers are especially options market makers, right? Those guys are hedging bets. They're bookies. And what's happening in the pre-market is indicative of what you're going to have to do to be neutral on the open. All the market maker wants to do is not have exposure to the movement of the stock. He wants to make on the options, you're looking to make the spread. You're looking to earn commission. You're not looking at whether or not it's going up or down. So in the pre-market, this is why I said it's a long only trade. What we're looking for is we want to see price moving higher. It's going to be choppy, right? Because it's pre-market data. We want to see price moving higher, and then we want to see the thing pull back to a threshold level. And in this case, the threshold level in that pre-market box is none other than the blue pivot. So stock, the price has moved up above the fulcrum that we expect for the session. And now it's trading up above R1. And when it comes down and it inflects inside that pre-market box right there, what we do is start to put together a trading plan that says on the open, if it hits 226.31, I want to take a trade that gets me up to 227.11. That's going to be my profit objective. And I'm going to have a stop down below those tails you see in the pre-market data there. So it has to trade down through the price. So we have to trade down through 226.31. And then when it trades up through it on the first attempt, we take the first entry, we take a second entry, we take a third entry. So that would all happen inside this box. And you can see here how just neatly the stock stayed right on top of that pivot line. So, today so far, we've been looking at gaps mostly, so I can't really tell you which ones are right on the pivots, but this happens pretty much every day that you see this kind of price action, where if you box it up in the pre-market and you look at those thresholds and you look at, all right, well, where is it in relation to a pivot line? If it gets into a pivot like that, you get this nice opportunity for 226.31 up to 227.12 once, twice, 3 times. Right? So this is a way that we structure things based on that timeline to take our personal psychology out of what we're doing. Like, I don't want to be sitting here guessing what to do with Apple. I'm not asking, is Apple long or short? Is Apple going up or down? What I'm saying is, I know that if this trade happens, if I get this inflection, we've done the statistics on it over the years, and I'm looking at a trade with about a 75 to 80% success rate over time. That's perfect for me. All right. So that's the first trade of the day. It's long only. If Apple was trending lower in the pre-market, no deal. Not taking the trade. I don't care what it does. Half the time, it'll wind up doing exactly what the model had suggested it was going to do to begin with, but that's half the time. The Model gets all of its validity, gets its strength from what happens when everything sets up the way that we expected it, the uptrend in the pre-market, move higher, then a move back down to a fulcrum, and then an entry. Do they happen every day? No. They happen probably 3 out of 5, 4 out of 5 days. They don't have to happen every day. We've got a bunch of stuff on deck over the course of the session that gets us in front of the opportunity for profit. Let me just show you the next one. This is that Baltimore chop that I was talking about. So this is all about putting probability on your side. And if you are a statistician, then you know, or if you took any statistics ever in your education, then you know that statistics work on a base of assumptions. And that base includes things like we want to know that the data that we're looking at is normally distributed. You have to have a normal distribution in order for things to behave the way that statistical models predict. So we draw a lot of engineers, right? A lot of guys who come to our boot camps and stuff. Those are engineers, and they're there because they're attracted to this idea that there's a mathematical basis for what's going on, and it's not just mathematical; it's predictive, because it's stats, right? Statistics are all about predicting things. In the case of the model that I'm going to show you now, you can use the more complicated version of it, the original version of it that I did in the original paper, use the implied volatility of the front month contract for every single stock on the S&P 500 as the base for the calculation. So it would go through and it would say, based on the normal volatility or the implied volatility of the stock, we have an earnings related gap today. Based on that implied volatility, are we out at least 2 standard deviations from the mean in order for us to get this mean reversion model to set up? And what we found out over time is true range is a really good proxy for volatility. Matter of fact, true range might actually be better because true range gives you that volatility, including gaps. And then the other thing is that volatility is mean reverting. And mean reversion is the most important assumption in this kind of a statistic. And all that mean reversion tells you is, look, you've got this bell-shaped curve. That's a normal population. So that's normal population data. So over the course of a day, 100% of what you can expect happens under this bell. And as you get further out into the tails of the bell to the right and the left there, right, 1 standard deviation, 2 standard deviations, 3 standard deviations, as you get closer to accounting for 100% of what's going to happen, you're going to have less and less expectancy that you're going to stay in that part of the tail, in that part of the distribution. Really what we're interested in is, here's the average. So this would be your average volatility. If we go out 1 standard deviation, we've got about 68% of what we think is going to happen has now been accounted for. So at this point, your assumption is you've got a 68% probability that price is going to move back toward that mean volatility, or it's going to move back toward the middle. If you go out 2 standard deviations, now you've accounted for 95% of what you expect to see. Now you're in the 95% confidence interval of the mean, is what it's called. If that starts moving out and qualifying at that range there, we start looking for a set of patterns to tell us it's an easy set of patterns, just 1, 2, 3 kind of a setup, or I call them a flip top on a long setup where it just breaks off the first bar breakout, or a trap door when it comes down from a high. But what we're going to focus on is just sort of the standard setup here on a 1, 2, 3. And I just want to make sure everybody understands range and true range, right? So we understand the volatility. If you're plugging this into your software, if you're going in and you're doing 2SD on TradeStation, or you're using Excel, or you're using Thinkorswim, there's been some people who put together this indicator for my stuff on just about everything. You're not going to use range, because the range is today's high minus the low. And what that's measuring is, right, here's the high, here's the low. And if the difference there, if it was $50.10 down to $49.40, the range was 70 cents for the day. That can be a useful calculation in terms of other things. It's not a useful calculation when you're looking at gaps. For gaps, what you need to use is true range, and just make sure that if you put this stuff into your software, you're doing true range, not average true range, because you want to create the average for the model. So the true range is going to be the greater value of the high minus the low, or the high minus the previous close, or the low minus the previous close, right? The absolute value of is what that means. So the absolute value is just it's a positive. It's the high minus the previous close is going to be a positive number. The low minus the close is going to be a positive number. So in this case, right, for that same bar, if you add the previous day's close, and we say the high of the previous day was still 50, or the high was 50.10, and the close of the day before that was 49 bucks. Now the true range is $1.10 because that accounts for the gap. You always want to look when you're doing statistics, you always want to make sure that the thing that you're measuring is actually the thing that you're interested in. That's why we use true range instead of range. So true range includes gaps. Gaps are the thing that we're actually interested in measuring. We want to know, is today's gap going to be 2 standard deviations, beyond the level that we would expect it to be. If it is, then our expectancy is it's going to come back down and it's going to track right in, right? So I'm going to show you how these set up. I'll show you an ideal example. I can pop out and show you the examples from today as well. So here's your mean reversion, right? This is simple. If it didn't make sense to you before, in the middle of a bunch of data, you have an average. This is an average value. In this case, it's the average volatility. Go out 2 standard deviations, you've got high volatility. Now you're expecting price to revert to the mean. You're expecting price to come back down toward the average. Doesn't mean it's going to close the gap. It doesn't mean that it's going to, go any particular distance automatically. It's not something you pre-program. This is a deal where you have to look at it and figure out where were the inflection points this morning, where was the significant volume, and how can I go and figure out where the most likely price target is? How can I figure out where the best stop is? And then I use those numbers to determine, is the reward to risk on it adequate for me to plan the trade and then trade the plan. So the formula inputs for a standard deviation, if you're going to do this yourself, if you want to load this into, so in Excel, you can just you can pull this data directly from your trading software and just have it do it for you. If you're going to program it in your trading software, this is the standard deviation formula that you would want to use. In this case, X is just each day's true range, and then you subtract from that the average of the 10 days worth of true range that we're looking at. You take that quantity and you square it to get rid of a negative number. You divide it by n, which is 10, which is the number of days you're looking at, or you can use n minus 1. That's a statistical thing for degrees of freedom. You really don't need it for this calculation. Take the square root. That's 1 standard deviation. So if I've got this data, and I've got day 1 through 10 there, and I take those numbers and I plug them into this formula, then what's going to happen is each one of those days, we're going to subtract the average from, and then we're going to divide it by this number 10. We're going to take the square root, and what that's going to give us is 1 SD. So 1 SD, 1 standard deviation, is 49 cents. 2 standard deviations would be 98 cents. We're going to add that to our average value, which is $1.25. So if the stock, in this case, gaps $2.23, right? 125 plus 98, that tells us that we've got a 95% probability of a mean reversion. So if these are 5-minute bars, and those last 4 bars, the ones on the left side of the screen, those ones that are climbing higher, if those are the last bars of yesterday, and then this morning the stock opens up down, and our software tells us that's a 2 standard deviation gap, then what I'm doing is I'm following the highs of the gap lower, because it's a gap lower. I'm going to follow down, and I'm going to say if it breaks a high, the lowest high in the whole bunch here, right? If it breaks that one, so any time in that chain there, right, you're always at the lowest high. The second bar has a high, that's the lowest high. The third bar has a high, that's the lowest high. The fourth bar has a high, that's the lowest high, and that's ultimately the one that becomes the lowest in the sequence. When that next bar breaks through it, I'm going to look at that first bar of trading, and I'm going to say, where is the where's the the significant price point there, the significant pain point, if you want to call it. And then based on that, I'm going to say, all right, if price gets back up there again, that's where I'm going to take a profit. So now let me switch screens for a second. I hope this works because nothing ever works quite the way I expect it to with this stuff, but here we go. So I should be sharing now one of my Realtic screens with you. And, what we're looking at here is this morning's trades. So we had, for example, we had one in Iridium. Let me just make this one larger for you. So this was a Baltimore chop trade that triggered for us. And you can see here that what happened was we had the move higher. Let me get an annotation tool for you. Well, I don't see the annotation tools. They're not popping up for me. So let's just look. Oh, they're there. Okay. We had the gap move higher. And once we gapped, right up into here. Once the gap happened, we got our alert. So we put this out to the guys in our room. If you'd like to join us in the room, I'll give you a link later that lets you sort of try everything that we do. But once we had this gap in place, you can see that we had a bar that went higher, another bar that went higher. And in this case, it's a short. So this was the threshold then for the entry on the trade. So 29.90 or 28.90 rather became the entry point for the trade that we were doing. And we did this one live in the room this morning. And we do all these trades live. Julie and I trade them in our own account. And we also, have a bunch of guys who are following what we're doing. You can see this out here. This is that volume by price cluster analysis that I was telling you about. So what this does is goes and says, this and this are the really important volume that happened as this stuff up here was going on. So when I'm looking at this trade, I've got a 28.90 entry, and I'm going to set a stop, probably up right around here initially. So the initial stop about $29.30. And then what I'm looking for is something really important that happened in the first bar of trading. So when you think about the ideal model that I showed you a second ago, look, when price opened, price traded from the opening tick, it traded down, and then it bounced. So if I see this happen again, right, if I get down to that level that identified where the stock bounced from, I don't care how much this price makes it down below that line. What I'm expecting to see happen is that price is going to inflect at the same level and bounce higher, because the only predictor that I have, the predictor variable that I have of what's going to go on here based on the behavior of the market this morning, right, the behavioral finance again, based on that, what I'm expecting to see is that if it gets here, it's going to bounce higher and it's going to wind up back up in here, and I'm going to give back some of the profits. So on our 28.90 entry, we had a 27.81 target, and you can see here that target played out just before we started talking here. It hit that threshold level. Then we also had Polaris, and now here you go again, right? Polaris gaps down, so it comes all the way down into $74.26, and then right you get 1, 2, right? It's not a 1, 2, 3. It's a 1, 2. And again, we see like all the pieces of the puzzle coming together. So if that's our threshold for entry, then is that 74.94 level, right? 74.94, 95, anywhere in there. Where's our stop going to go? We'll put it under this cluster analysis here. So 74.37 would be the first place that I'm looking at for a stop. And then I'm going to look out here at all this volume by price data, right, and start trying to figure out where would I want to put my profit objective on this so that I capture most of this range, but not this violent move back down into the range. It opened, got way up in here, and then something reversed it. Where is it? Whoop, right out here, right? And you can do this with your normal, just sort of volume by price data as well. Just go, on Thinkorswim or eSignal, and all those other platforms, and TradeStation. It tends to run the VBP bars back this way, so you sort of have to move the scaling around a little bit, and it's not going to take out. See here how there's these gaps. It's not going to create these gaps where volume is insignificant. So where the volume is insignificant, what I'm expecting is that when price gets there, just like it just did, right, that it's going to pop down, that it's going to have easy range of motion, easy travel range to get back into there again. But again, in this case, right, 74.94 up to 76.83. And so we already looked at Iridium, we had PII, and we also had, I guess, AOS, right? So AOS, this was a flip top. So this one would be, we can't really get too deep into all this stuff, but I mean, this would be, so the flip top is called a flip top because the first bar is the deepest bar in the pullback. And what we do here is we do the fib expansion. So you can see that using a 382 or a 50% fib expansion, right, would give you a target. So an 83.57 entry, give you an 84.73 conservative target, and an 85.09 expansion target. So that would be, it exactly hit the 50%. That's something that happens kind of frequently, right? Is that 150% of the original move winds up being reverses. It's not even a fib number, right? 50 is not a fib number, but man, it sure works. And in this case, something like this happens on this kind of a setup. What we use as a stop is usually initially is going to be our entry bar low. And this one was a little wide for my taste, right? So you had a 82.33 stop, but it is what it is, and you can move it up, but you don't want to move it up to where you're going to wind up getting stopped out just on the wiggle. So if the stop's too wide, I mean, for me, I'll take these even on a 1-to-1 reward to risk ratio like this, because I know it's in the 95% confidence interval of the mean. The flip top is a harder way to trade this. It's not quite as simple as trading the 1-2-3 setup. So, a lot of the boot camp guys love the flip tops and trapdoors. That's great because they work, and they can be these really violent moves that are quick, and you're in, you're out. But if you're just starting, or if you're just going to go home and try to work with these, or if you're going to join us in the room for the next couple of weeks and watch what we do, just stick to the 1-2-3 things, because those they're kind of gimmies. They're much easier to work with. So let me go back to our presentation here, and we'll move on. And the next thing that I want to talk about is something I call volatility bands. So if you guys know my trading, if you've seen us on the show, so Julie and I do a TV show, Trader Nation, which is currently on hiatus, and I don't know, may or may not be on hiatus for a while here. But I also do a live stream. So the live stream you can be part of if you'd like. That's very, very simple. I just send a text message out every day. It's free. You get a text message that says, Adrian's about to go live. And what I'm doing there is just talking about these things, these volatility bands, and I'm going to show you here next. So let me just jump to the correct slide, because running kind of funny on time here. So this is Meta. And now let's talk about how to put the indicators together and have the indicators make sense, and have the indicators make it easy to figure out sort of what's going to happen for the day, or what's going to happen for the rest of the day. Again, Julie and I have been trading for about 30 years, right, together. So a lot of this stuff seems second nature to us. It just pops out at us. But it's not second nature for most people, right? Most people look at this stuff up here and say, well, what am I supposed to do with that? Or they'll look at this stuff out here and say, what are we supposed to do with this? So on that timeline, right, we're sort of trading like clockwork, if you want to say. We had, if you looked at the midday to the latter part of the day, we're trading the Magnificent Seven stocks. So I did a whole big course for the boot camp guys on the Magnificent Seven and what it is that Julie and I are doing with them. And while this looks to most people like a whole lot of nothing, this looks to me like a whole lot of money. And the first indicator that we would put on this, we would go through and do just horizontal lines at natural support and resistance. We're looking for where's the order flow bunched up, right? So where are, if I'm a specialist in Meta, if I'm on the floor of the exchange and I'm the designated market maker in a stock, what I'm going to do is I'm going to say I'm a buyer at a certain level, I'm a seller at a certain level. That's going to be constant. I'm just going to say I'm a buyer here, I'm a seller here, a buyer here, a seller here. And 481.72 to me right here says, that's kind of the buy line around the open. You don't know that until after the fact in this case. So it's great that you can pinpoint where the buying and selling was taking place around the opening bell, but the only thing you see is that happened 20 minutes ago or an hour ago, right? Now let's add the next indicator. Let's add the indicator that I showed you first, the pivot lines. And lo and behold, if what I see first thing in the morning is a move that gets me up through R1, R1 again is that blue line. If I'm up above that R1 line and I see that price goes up, makes a high, reverses, dips the R1 line, comes back up through, that's a trade that's worth taking. Because what I know now is R1 is going to be a very likely place. There's going to be an inflection. Prove it to yourself. Just go through, plot the pivot lines on your chart, and see how often, if price moves directionally through one of those pivots, when it comes back to the pivot, how often that price goes and inflects. And what that does, if you have that sitting there, it takes the mystery out of this for you and says, and I tell the guys, I say all the time, just take, the first one, the second one, third one, you're going back to the well too many times. You've got a real high probability that it's going to fade on you, right? You're retesting areas of volume. You're retesting areas of buy side volume here, and eventually buy side volume is going to get exhausted. The more often it tests it, the higher the likelihood it's going to wind up going lower. So we take one, we take two, third one, we sit on our hands. But you can see each time price comes directionally into the pivot. So when it was up above the pivot and comes back down, what's the highest likelihood? It's going to bounce and it's going to go higher. When it's down below the pivot and it comes up, we've got a really good opportunity for a short sale. We've got an opportunity for price to move lower. So now we've got basically two indicators in place. We've got our horizontal lines, right, which is always the best indication of what's going on is where price has been. You've boxed it up, you go through, you set up these ranges. You could do it without the pivot lines. As price moves into the latter part of the session, right around 11:30 Eastern time, we start trading from those lines religiously. So if you look at this chart and you see, oh, gee, look at that. It gets down to 476.22, moves up, that 479.97 line is the overhead. And then it starts forming this range at that 478.22 level. I'll take that trade, again, 2 or 3 times. Well, third time, I'm not taking it. 1 or 2 times, I'll take the inflection. Third time, I let it go. And if you look at the chart, you can see third time it went down below. But how do we make the data even better? So how do we go through and say, now let's really handicap what's going on here and figure out when price is in the circle or price is in that box, what are we going to do with price in terms of planning what we're going to do next for the trading session. So let me go back to some live charts here again. And, let's just take a look at how we can set these up for the rest of today. Just make sure I'm sharing the right screen. Make this chart nice and big for you. Load it up on the whole screen. Big monitors that we bought for the road here. Okay, now let's look at our Mag 7. So Apple, I don't really trade much into the session. And I wouldn't necessarily be setting these up just yet. So normally I'd start setting these up 11-ish for trading into the afternoon. So Apple here, I don't really see that it's forming anything too useful yet. Google, I might start saying, all right, let's take a look at this range here if it gets back into it. And then let's look at this prior data here down into here. So we'll watch Google over the course of the day and see, does it start to inflect at these points that it inflected at before? And does it fall in? You see how the volume by price clusters inside those ranges? We like to see that. Meta, this is one that we trade, almost every day. And again, just because they're expensive doesn't mean you shouldn't trade them. Just cut your share size down and, problem solved. I mean, there's all these guys just always want to fire off 1,000 shares of everything. And I say, why would you do that? Manage your risk, make sure that your exposure on any of these stocks is relatively in the same ballpark. So you see what I'm doing here, right? I'm going through and I'm lining things up, not just by where the price tends to aggregate, but also where the volume by price clusters are. And we're going to see over the course of the day, how does this one set up? How does this one play out? Then we also look at Netflix quite a bit. Netflix is in the box, as we like to say. So, this one, we're probably looking at this, 642.85-ish level up into 645.46. I'm going to expect that over the course of the day, we're probably going to see an additional threshold level building up in here somewhere, so that the range is probably going to tighten up a little bit. That's based on what happened yesterday, based on how this is clustering here. We trade NVIDIA pretty much all day, every day. This one hasn't really gone. So what's nice about this time of day, sort of going into 11:30, you're going to start seeing this price settle in and start moving more sideways. And those sideways moves, like I said, a lot of people look at it and they, don't want to trade during the New York lunch, don't want to trade, there's, the volatility is too constrained. That's my favorite time of the day to do the Mag 7, because I'm setting these guys up just like this. And I'm just watching to see, do we get back into these price ranges? What we haven't seen yet is one that's really trending. Oh, here we go, Tesla. All right, so Tesla's in a big trend. And, here's where we'd use this anchored VWAP. I'll do this in orange. I always do it in orange. So you see how the stock moved from the high, sort of down into a base. And that base really started, about 950-ish. So what I'll do is I'll say, starting at the beginning of the day and ending about here, where is that volume weighted average price? So this is going to be a little bit different than your session VWAP. So if I add, just put this on here for you to look at, because you can see the value in it. And you always want to reset it each day for intraday data. And then let's make that orange too, just to not further confuse the issue, right? So you can see that over the course of the session, right, this VWAP is gonna do what it's gonna do. It's gonna trail off, and our anchored VWAP is gonna tell us a little something different. So we can see that in this range here, no surprise, that's where the volume weighted average price was. And now that it's taken off to the downside, right, what's going on here? Geez, let's take a look. Oh, look at that. Most of what's happening is happening right there. And then when I go and I add a little bit of analysis to this, I can see here that, yesterday's data floats through here. Really, you sort of want to catch the highs, lows, opens, closes when you do this kind of a thing. And you can see how we're starting to put together the picture for how we're going to trade the afternoon. So if you guys are watching those live stream videos that I do, I haven't done them for a couple of weeks because of the little skin cancer thing, and I am who I am, and I don't necessarily want to be on there all bandaged up. But I'll be back. I'll be back probably tomorrow. Um, you can see here, right? We've got this thing set up in a way that it's going to make sense for the rest of the trading session. So, when you get a trending move, the trending move is what tells you whether or not to use the volume weighted average prices, the anchored VWAPs. If it's not on a trend, if it's just going sideways, then you're happy just boxing things up. And then you always want to look at, no matter which version of volume by price you're using, if you're using the traditional or this, you want to see, how do your lines correlate with what's going on over here. This is what you should shoot for, is that the things that you isolate also are isolated over here, so that you're really seeing order flow. You're really seeing where the pockets of volatility are. Amazon is also trending today, I know. So, this one would be the last of the Mag 7 for us to look at. You get threshold levels here and here. If you guys are here, if you're my guys, right, you got an infield fly set up here. You've got the every indicator here telling you exactly that this was going to happen, so you should have known it. If you were watching it, you should have been on it. If you weren't watching it, don't worry about it. There's plenty of stuff to watch the rest of the day. So, really, we don't have a lot of thresholds in place on Amazon. But if we go through and we start picking this apart and figuring out just what it is that happened today, okay, if price gets down into that anchored VWAP, even though we don't have a bunch of support and resistance that we can eyeball right there, I can tell you for sure, I'm going to look for price to move just below the anchored VWAP, hit this threshold level of volume by price, and then I'm going to look for an inflection move from 187.11 up to 187.65, and that's the way that I would trade it. So, that's kind of a mouthful. I mean, it's a bunch of stuff, I know, but it's only a quarter of what we do. We do a lot of live analysis with our guys. We do a lot of stuff at the boot camps even, right? So the whole purpose of boot camp is before you go, you get a 650-page workbook. You get 40 hours or 60 hours even of online training that you have to go through. It's real organized coursework. And then we fly down to Miami Beach because that's a great place to do the boot camp because of the time zone, right? Nobody wants to. LA is beautiful. Malibu is beautiful. People come out there and they're like 6:30 in the morning. There's a no-go. And I understand. So we do it in Miami. And, the first day is sort of a meet and greet. We all talk, we get to know each other. People, make friends and trading partners and all that kind of stuff. There's only 20 people there, right? We only do 20 people at those things. Second day, third day, fourth day, that's live trading, and this is what we're doing. We're going through with the guys and we're saying, look, you've got to learn to box this stuff up. You've got to learn to set these things up. They bring their laptops. They're actually taking the trades. It's great. They, most of the guys are doing really well by the time they get done with the boot camp. So that is a lot of fun for us and a lot of fun for them. So let me go back to this guy here. If you have questions, we can answer them now. If you want to do a 2-week trial of our morning room or of our war room, we're there Tuesday, Wednesday, Thursday. We're there all day. Monday, we are pretty much off. Mondays aren't a great day to trade in general. If we're doing anything, it's just those magnificent 7 trades in the afternoon. Tuesday, Wednesday, Thursday, the way that we run it is we're there from the open through the first hour. Then we take a break. I walk on the beach for a little bit. About an hour later, I come back. I start setting up for the afternoon, and then we trade right into the closing bell. So you can do that. There's a 2-week trial there. If you want to do it, we'll give you a 4-week trial. I'd rather have you tell us whether or not it's for you than have us try to tell you come work with us. Better for you to make the choice than us. And then you can also do trade. Let me type it in here for you, because this one I forgot to put in is there it is, TraderInsight.com/live-stream. So if you go to that web page, that'll give you, you can just you can sign up there for the text alert that tells you I'm about to go live on the air. And then you can watch the live broadcast on your iPhone or on your computer or whatever. And what I do there is I do just what I just did now, right? I go through and I say, all right, here's the levels that we're looking at. Here's what we expect to see happen over the course of the afternoon. This is where we're going to do the trades. And, we set them up with the guys. You guys can ask questions if you want there. And it's really a pretty good thing all told. So, all right. So does anybody have questions? I've just got a couple minutes left. I know we usually get more people watching these things on the replays than we do live first thing in the morning. But if that's it, I will call it I'll call it a day here. Hopefully you guys enjoyed it. Hopefully you'll learn something. If you have any questions, you can always shoot me an email, Adrian@TraderInsight.com.